Okay, so you want to own a prison. You find a piece of land somewhere outside a small town, you build some walls, string up some wire, and then here's the part that sounds almost too good to be true. The United States government signs a contract to fill it with people and pay you for every single one of them. Every day. Guaranteed. A customer base you didn't have to market to. A revenue stream backed by the full power of the federal government. And a product nobody can get anywhere else. No Yelp reviews, no competition from a startup, no worrying about whether consumers are going to switch brands this quarter. Sounds like the most recession-proof business ever invented. It is not. And the story of how private prisons actually make money and why some of the smartest investors in the country have lost enormous amounts of it trying is one of the darkest and most misunderstood stories in all of American business. Before we talk numbers, we need to clear something up, because most people picture private prisons completely wrong. A private prison does not arrest people. It does not decide who goes to jail or for how long. It does not set sentencing guidelines. What it does is sign a contract with the government agency, federal, state, or local, that says, we will house your inmates, feed them, provide medical care, maintain security, and manage the facility. In exchange, you pay us a fixed daily rate per person. That daily rate is called the per diem, and it is the entire engine of this business. Per diem rates vary widely depending on the contract, the facility's security level, and the state. A federal immigration detention facility is priced differently from a medium security state prison, which is priced differently again from a minimum security work camp. CoreCivic, one of the two largest private prison operators in America, reports its revenue in terms of revenue per compensated man day, and that number shifts contract by contract, year by year. To give you a workable example, documented per diem rates in various state contracts have ranged from under $50 per person per day at lower security facilities to well above $100 at specialized or high security ones. For this analysis, let's work with a realistic middle ground example of $68 per day. Take a facility holding 1,500 inmates. At $68 per person per day, that is just over $102,000 of revenue every single day. Multiply that across a full year, and you are looking at gross revenue of approximately $37 million. From one facility operating near full capacity under a government contract. That number is why private prison companies grew so fast. That number is why Wall Street paid attention. And that number is exactly why understanding what sits underneath it matters so much. Because the gap between $37 million in gross revenue and actual profit is where this entire business model either works or completely falls apart. Building a prison is not like building a warehouse. You cannot throw up steel walls and call it done. Construction costs for correctional facilities vary significantly based on security level, location, and design. But a modern facility built to federal or state standards is a major capital commitment. Industry figures and government project data show costs ranging from tens of millions for smaller or lower security facilities to well over $200 million for larger, higher security builds. Some state projects have exceeded $400 million. That price tag includes perimeter security systems, individual housing units, a medical facility that meets federal standards, a commercial kitchen capable of producing thousands of meals every single day, administrative offices, visitation areas, recreational spaces required by law, and the specialized infrastructure. Reinforced doors, integrated monitoring systems, controlled access points that makes the building function as a secure facility rather than just a large building. The two largest private prison operators in America, CoreCivic and the Geo Group, between them manage dozens of facilities across the country, ranging from local detention centers to large state and federal prisons. Neither one started with a small pilot project. You need serious capital before you sign your first government contract. And unlike a shopping mall, where you can open with 60% occupancy and still generate some revenue, a prison has to be fully ready to operate before a single inmate walks through the door. Here is where most people's mental model of the private prison business breaks down completely. A prison never closes. Not on weekends, not on holidays, not on slow days. It operates 24 hours a day, 365 days a year. And correctional standards, whether written into the government contract, mandated by state law, or enforced by accreditation bodies, impose required security posts and minimum staffing levels that cannot simply be ignored. If your staffing drops below required levels consistently enough, you risk losing the contract entirely. And an empty prison generates $0 in daily revenue while still requiring you to heat the building, maintain the systems, pay your remaining staff, and keep making payments on the loan you used to construct the place. Staffing a large facility of this type requires hundreds of employees working rotating 12-hour shifts. Nights, weekends, holidays. There is no such thing as a slow season in a prison. And the turnover rate in this industry is severe. Research from various state correctional departments and industry groups has consistently found correctional officer turnover at private facilities running significantly higher than in most other industries, with some facilities reporting annual turnover rates in the range of 30 to 50%. That means in any given year, you may be replacing a large portion of your workforce. Every new hire needs background checks, weeks of classroom training, supervised floor time before they are cleared to work independently, and months before they are fully effective. The constant churn of recruitment, screening, and training is a cost that never appears in the per diem calculation, and it never goes away. Now, here is the part of this business that sounds extraordinary, because it is. Some government contracts with private prison operators have included what is called a guaranteed occupancy clause. The government agrees to keep the facility at a minimum percentage of capacity, in documented historical cases as high as 90%, regardless of how many actual inmates the system produces at any given time. If the prison population drops because of a change in sentencing policy, a drop in crime rates, or a shift in how the courts handle certain cases, the government still pays as if the beds were full. Let that land for a moment. The government pays you even when the beds are empty. This clause is the reason private prison companies attracted such intense investor interest in the 1990s and 2000s. It looked like a floor underneath the revenue. It looked like downside protection built directly into the contract. And for a period of time, in certain states, it performed exactly that way. But it is also the clause that turned this industry into a political lightning rod it has never fully escaped. Because critics pointed out something that is genuinely difficult to argue with. If your revenue depends on keeping a building full of inmates, you have a financial incentive for incarceration rates to stay high. Several facilities operating under occupancy guarantee contracts pursued legal action against state governments when prison reform efforts reduced the population below the guaranteed level. The state passed a law to reduce incarceration. The private prison company filed to collect the difference. That is a headline that follows an industry for a very long time. In August 2016, the United States Department of Justice issued a memo announcing it would phase out the use of privately operated criminal detention facilities at the federal level. The reasoning was that private facilities were less safe, less effective, and provided fewer rehabilitative programs than government-run ones. On the day that memo became public, shares of both major private prison operators, CoreCivic and Geo Group, plunged by more than 35%. In a single trading session, billions of dollars in market value evaporated because one policy document changed hands. Then, in early 2017, the policy reversed. Under a new administration, the stocks recovered. Then in 2021, another executive order directed the DOJ to phase out its privately operated criminal detention contracts specifically. Then the legal and contractual battles over implementation began. This is the structural risk at the heart of this entire industry, and it is the one that no financial model fully captures. Your customer is the government, and governments change. A contract that looked iron solid for 20 years can be unwound by a policy decision made in an afternoon. The revenue base of an entire private prison company, hundreds of millions of dollars per year, sits on a political foundation that can shift without any warning. Every other business on this channel has market risk. Private prisons have market risk and political risk simultaneously, layered on top of each other, with no real hedge available for either. Let's run an honest scenario. A realistic single facility, 1,500 beds, operating at 88% capacity, which is strong for this industry. At a per diem of $68 per person per day, gross annual revenue comes to approximately $32.6 million. Against that, staffing costs for roughly 400 employees at an average total compensation, salary, benefits, retirement, workers' compensation of about $58,000 per year runs approximately $23 million. That is over 70 cents of every dollar of revenue going directly to the people who keep the building running. Food service for 1,320 inmates, 3 meals per day, 365 days per year, at a cost of about $4 per meal, adds another $5.8 million per year. Medical costs, which private prisons are contractually and legally required to provide at a standard the courts will enforce, add $2 to $5 million depending on the age and health of the population. An aging inmate population with chronic conditions is dramatically more expensive to house medically than a younger one. Utilities, maintenance, insurance, and administrative overhead add another $2 to $4 million. Added up, staffing, food, medical, and overhead together can run $33 to $36 million or more on a facility of this size, against gross revenue of $32.6 million. Before debt service on construction financing, this scenario does not produce profit. It produces a loss, or at best, a break-even in a typical year. The math on return on assets is not just unimpressive. At many facilities, it is negative before financing costs are even counted. And this is a good year, at high occupancy, with a stable contract and no major staffing crisis. To understand what the bad version of this business looks like, you need to know what happened at the Walnut Grove Youth Correctional Facility in Mississippi. Walnut Grove had a troubled history under multiple operators over the years. By 2012, when a federal judge issued a landmark ruling on conditions at the facility, it had become one of the most documented examples of what can go wrong when oversight fails inside a privately managed correctional facility. Judge Carlton Reeves described what investigators found as, and this is a direct quote from the court record, a picture of such horror as should be unrealized anywhere in the civilized world. The court found unconstitutionally inadequate medical care. It found that gang activity had operated largely unchecked inside the facility. It found a pattern of staff-on-inmate abuse that had gone unaddressed for years. The facility changed private operators after the 2012 crisis and was ultimately closed by the state in 2016. Each operator that came through lost the revenue stream when the arrangement ended. Here is the lesson that the per diem math does not show you. You were not just managing a building. You are managing a population that the government and the federal courts will hold you legally accountable for every single day. The liability exposure when conditions deteriorate is not limited to losing one contract. It extends into federal civil rights litigation, court-mandated oversight, consent decrees that follow the company for years, and reputational damage that affects your ability to win contracts at other facilities long after the original problem is resolved. A mall that loses an anchor tenant loses rent. A prison that loses the government contract over documented failures loses the revenue, the asset's purpose, and frequently, the company's credibility in every other market it operates in simultaneously. CoreCivic, one of the two largest private prison operators in the United States, reported total revenue of approximately $2.2 billion in their most recent annual filing, with net income of approximately $116 million. That works out to a net profit margin in the mid-single digits, not a spectacular number for a business with this much political risk, this much staffing complexity, and this much dependence on a single type of customer. Geo Group reports in a similar range. Both companies have traded at valuation multiples significantly below comparable real estate businesses for years. Because the market is pricing in exactly what we just described: policy reversal risk, occupancy uncertainty, perpetual staffing pressure, and liability exposure that most businesses simply do not carry. Here is the honest answer. Private prisons exist. They generate revenue. Some of them have been profitable for extended periods. The industry has not collapsed. Core Civic and Geo Group are publicly traded companies that have operated for decades. But the business is not what the per diem math makes it look like from the outside. The revenue is set by a government contract you did not write and cannot renegotiate unilaterally. The costs are driven by labor markets and medical and legal requirements that move independent of what the contract pays you. The political foundation underneath the entire model can shift without warning and without compensation. And the liability exposure for operating failures is not contained to a single facility. It follows the company across every contract it holds. The shopping mall is a bet on a neighborhood. The ranch is a bet on weather and cattle markets. The airport is a bet on passenger growth over several decades. The private prison is a bet on government policy staying stable, in a country that changes governments every 4 years and changes policy every time it does. The per diem arrives every single day. That part is real. What is also real is that the government writing that check is simultaneously the regulator setting your standards, the customer setting your contract terms, and the political actor who can decide, on any given Tuesday, that the entire arrangement no longer serves the public interest. In most businesses, those are 3 separate parties with competing interests keeping each other in balance. In the private prison business, they are the same party. And that is the detail the per diem number will never show you.